Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're taking a closer look at the latest financial performance of Avenue Supermarts Ltd, the company behind the DMart stores you see across India. And to guide us, we've got their recent press release with the Q1 results ending June 30, 2025. We also have their investor presentation for the bigger picture and, of course, the official filings, including the auditor's report. Our mission, really, is to unpack these numbers, understand the trends, and figure out the why. The story behind the performance of, frankly, one of India's biggest food and grocery retailers. And look, right away, there's something interesting for you. Standalone total revenue, up a solid 16.2%. That's RS. 15,932 crore. Pretty impressive growth. But here's the twist. Standalone profit after tax, or PAT. It's up only 2.1%, which is RS. 830 crore. I mean, that's quite a gap, isn't it? Makes you lean in and ask, okay, what's actually going on here? What's causing that divergence? Okay, let's unpack these figures then.
We're looking at Q1 FY26, so that's the quarter ended June 30, 2025, and comparing it year on year with Q1 FY25, starting with standalone results, just the core DMart business. Total revenue, as we said, ours 15,932 crore, up from ours 13,712 crore. That's a 16.2% jump. Now, EBITDA, earnings before interest, tax, depreciation, amortization, that came in at ours 1,313 crore, up from ours 1,221 crore last year. So a 7.6% growth there. But, and this is key, their EBITDA margin actually went down, fell to 8.2% from 8.9%. And
Yeah, and what's fascinating there, when that EBITDA margin drops, it's telling you something fundamental about core operational efficiency. It's under pressure, right? Even before you factor in financing or taxes. It suggests costs are, well, growing faster than sales. And you see that trend continue down the income statement. Net profit after tax, PXE, was Rs 830 crore. That's up from Rs 812 crore, like you said, the 2.1% growth. But the PAT margin also dropped, down to 5.2% from 5.9%. And basic EPS, earnings per share, for Q1 FY26 was Rs 12.75, just slightly up from Rs 12.49 last year.
So strong revenue growth for the core DMart stores. Okay, but definitely a squeeze on the profit margins. What about when we look at the consolidated results? Including their other businesses, does that picture look even tougher?
It absolutely does. And it gives you that full comprehensive view, right? The consolidated total revenue was Rs 16,360 crore. That's up from Rs
Hmm.
14,069 crore.
Yeah.
So again, very similar growth, 60.3%,
Yeah.
pretty much neck and neck with standalone. But the consolidated EBITDA, Rs 1,299 crore, up from Rs 1,221 crore. That's only 6.4% growth, so actually lower than the standalone EBITDA growth.
Yeah.
And the margin fell even more, down to 7.9% from 8.7%. And here's where it gets, well, particularly interesting or challenging, depending on how you look at it. Consolidated P was Rs 773 crore. That's actually a tiny bit down from Rs 774 crore last year, a slight decrease.
Wow. Okay, so consolidated profit actually dipped.
Yeah. Which means the consolidated PT margin also fell, obviously, down to 4.7% from 5.5%. And the consolidated basic EPS, Rs 11.88,
Right.
down slightly from Rs 11.89. So if we connect this to the bigger picture, this slight dip in consolidated profit, despite that really strong revenue, it's not just a blip. It kind of signals that even these retail giants like DMart aren't immune to these broader margin pressures we're seeing globally in consumer goods. It really makes you ask, how much more efficient can they possibly get? And what are the factors driving this clear gap between strong sales and squeezed profits?
That really is the key question, isn't it? My first thought goes to, rising costs, maybe supply chain issues, but I guess it's probably more complex. What's the initial sense you get from the reports about the why?
Exactly. It's usually a mix of things. And the CEO, Mr. Neville Narona, he actually points out a few key reasons for that profitability squeeze. But before we dive into his comments, it's maybe worth just appreciating the operational scale here. Because beyond just the financials, DMart's story this quarter is also very much about physical expansion.
Oh, absolutely. And it's quite something. They added, what, 9 new stores in Q1 FY26,
That's right, 9 new ones.
bringing their total store count to 424 as of June 30th. And the total retail space, 17.2 million square feet. That's a huge amount of floor space.
It really is. And that expansion, it's critical, but it's not just random.
Mhm.
It's very strategic. They call it their cluster-based expansion strategy in the investor presentation. It's not just opening stores anywhere. It's about building density in specific regions. So like as of Q1, you see heavy concentration in states like Maharashtra, 117 stores there.
Wow, 117.
Yeah. Then Gujarat was 68, Telangana 45, Karnataka 41, Andhra Pradesh also 41. This strategy, it basically lets them leverage their existing supply chains, their brand recognition in markets they already know well. It makes the expansion more efficient, you see.
Right, building on strength. And talking about growth, it's not just the new stores driving it, is it? There's this metric like for like growth, LFL, same store sales. How did that look?
That's a crucial one for retail, yeah.
And the CEO, Neville Narana, he specifically said, 2 years and older DMart stores grew by 7.1% during Q1 FY26 as compared to Q1 FY25. So that tells you even their mature stores, the ones that have been around a while, they're still pulling in more sales year on year. It's not just the new openings fueling everything.
Exactly. Healthy growth from the existing base, too.
And it's not just physical stores either. DMart Ready, their online channel, that's growing too, right?
Oh, yes, quite significantly.
Still focused on the larger towns, but expanding. They went from just one city back in, 2016-17?
Yeah, very early days.
To 24 cities now in Q1 FY26. Places like Mumbai, Pune, Bangalore, Hyderabad, Jaipur, they're all covered by DMart Ready now.
It's a serious push into omnichannel. And just briefly, when we think about what's in those stores and online carts, it's useful to remember their main categories: foods, non-foods, which is basically FMCG, like home care, personal care, and then general merchandise and apparel. So dairy, fruit and veg, staples, but also detergents, soaps, clothes, even some home appliances. It's pretty broad. Just for context, back in Q1 FY25, food was about 55% of revenue, non-foods around 25%. Gives you a sense of the mix.
Right. So, okay, the numbers show growth, but with that profitability challenge. Operationally, they're expanding both physically and digitally. So let's get back to that why. The margin pressure. What did Mr. Narona actually say was causing it?
Okay, yeah, let's get into his commentary. He highlighted a few key things.
First off, he mentioned deflation. He actually said revenue growth impact of approximately 150 BPs was primarily due to high deflation in many staples and non-food products. Okay, 150 BPs, that's basis points. So 1 to 1.5 percentage points of revenue growth impacted just by falling prices.
Exactly. Think about it like this. If the price of, say, cooking oil or flour or detergent drops, it's great for you as a shopper, right?
Yes.
But for DMart, it means they have to sell a lot more volume just to make the same amount of money. And this is a really interesting challenge for their whole everyday low price or EDLP model. You'd think lower prices fit their strategy, but when prices fall across the board, their gross margins get squeezed. They still have all their fixed costs, rent, salaries, electricity, and unless they sell massively more units, that profit takes a hit.
Okay, that makes sense. It's counterintuitive, but yeah, deflation hurts their margin per item sold. So falling prices is one pressure point. What else?
Well, adding to that, Mr. Narana also spoke about continued competitive intensity within the FMCG space, which he said directly led to lower gross margins compared to last year. So basically, competition is fierce.
Everyone's fighting hard on price.
Precisely. They're likely having to keep prices super low, maybe even run more promotions just to compete, and that eats into their profitability. And then there's the other side of the coin, rising operating costs.
Okay, so prices coming down on one side, costs going up on the other.
You got it.
Yeah.
He attributed this increase to their efforts on improving service levels, capacity building, and inflation at entry-level wages.
Right, so investing in the business, better service, bigger capacity, plus wages going up, especially for frontline staff. That's a classic cost squeeze.
It really is. It's like trying to grow, but finding the costs of that growth, like maybe higher staff costs or investments in better warehousing, are eating into the benefits. Plus, basic wage inflation. It's a multi-pronged pressure on the bottom line.
And this all ties back directly to their core strategy, doesn't it? That everyday low cost, everyday low price, EDLC, EDLP model. Their whole thing is about being super efficient, buying cheap, running lean operations, and passing savings to customers through low prices.
Exactly. That's the foundation.
So when you understand that, you can see why they'd be particularly sensitive to deflation because their margins are already lean. And intense competition forces them to cut prices even further. And rising operating costs hit them hard because they're trying to minimize those costs constantly.
It highlights the inherent tension in that model, especially in the current economic climate. Their strength low prices becomes a vulnerability when input prices fall or operating costs rise significantly. And just, for completeness, these numbers we've been discussing, the unaudited financials, they were formally approved by their board of directors on July 11, 2025, and their auditors, SRB Co. LLP, issued a limited review report.
Right.
So standard procedure gives us confidence in the data.
Right. The necessary checks and balances. And just so you, the listener, understand the full scope when we talk consolidated, that includes Avenue Supermarts, the parent company, plus its main subsidiaries. We're talking Avenue E-commerce Ltd, that's DMart Ready, Also align retail trades, Nahar, Seth and Jagani developers, Avenue Food Plaza, and Reflect Healthcare and Retail.
Yeah, it bundles everything together, the stores, the online business, maybe some real estate aspects, food courts, potentially pharmacy. It
Yeah.
gives you the total group picture.
Okay, so let's try and wrap this up. Summarizing our deep dive into DMart's Q1 FY26. We saw really robust top-line growth. They're still expanding aggressively, adding 9 new stores. And DMart Ready, their digital side, is now in 24 cities. So strong expansion continues.
Definitely. But, and it's a significant, the company faced real pressure on its profitability margins. And that came down to, well, a few key things. High deflation in staples and non-food items hurting revenue value. Intense competition, especially in FMCG, forcing prices down and squeezing gross margins. And rising operating costs from investments in service, capacity, and also wage inflation at the entry level.
So the final thought for you to consider is this. DMart is sticking to its guns with this everyday low cost, everyday low price strategy, even with these challenges. What does this Q1 performance tell us about how sustainable that model is in the face of deflation and intense competition? And what does it signal about the wider retail sector dynamics in India right now? Is that core strength, the relentless focus on low prices, also potentially their Achilles heel when the market dynamics shift like this? Something to think about.